If you are watching this right now, I want you to understand something very clearly. The signal that is forming in Bitcoin is not a normal market fluctuation. What we are witnessing resembles moments in financial history that only become obvious in hindsight. Moments when volatility stops being noise and starts becoming a warning. Just a few months ago, Bitcoin was trading above $120,000. The mood was euphoric, liquidity was abundant, and narratives about institutional demand dominated every discussion. But today, you are looking at a market that has fallen toward the 70,000 range, a drawdown of more than 40% from the peak. And that kind of move is never random. I want you to think carefully about what happens in markets when momentum breaks. The first thing that changes is not price, it is confidence. You begin to see small cracks, signals that most people ignore. Trading volume that once surged above $2 trillion in a single month starts to fade. Volatility increases, but the rallies become weaker. Buyers hesitate. Sellers become faster. These are the kinds of signals that historically have appeared before major transitions. Whether in the technology bubble of 2000, the commodity cycle of 2008, or even the crypto downturn of 2022, markets rarely collapse without first sending warnings. Now, look deeper, because price alone never tells the full story. Behind every chart, there are structural forces at work. Liquidity conditions globally have tightened compared to the stimulus-driven years after the pandemic. Real interest rates remain historically elevated, compared to the era that fueled speculative expansion. Capital has a cost again, and when capital has a cost, risk assets behave differently. Bitcoin does not trade in isolation. It reacts to the same global monetary currents that move equities, commodities, and currencies. When the cost of money rises, volatility becomes more violent and trends become less stable. There is also a psychological dimension that you must not underestimate. After large rallies, markets often experience what analysts call fatigue. This is not a technical indicator. It is a behavioral reality. Investors who bought late become trapped. Early buyers begin to take profits. New participants hesitate to enter after sharp declines. This creates a period where price movements become erratic, and that erratic behavior is often mistaken for stability. But historically, these quiet and uncertain periods are exactly when larger moves begin to build beneath the surface. If you look globally, you will notice that this is not just a local phenomenon or a single market anomaly. Similar volatility patterns are appearing across multiple risk assets. Equity markets have shown increased sensitivity to macroeconomic data. Commodity markets have reacted sharply to currency fluctuations and geopolitical uncertainty. When you see synchronized volatility across asset classes, it is often a sign that the underlying driver is macroeconomic, not sector-specific. And that is why what is happening in Bitcoin cannot be dismissed as merely a crypto event. But here is the contradiction that makes this moment so fascinating and so dangerous to misinterpret. Despite regulatory progress, despite political rhetoric that appears supportive, despite continued institutional infrastructure development, the price has struggled to maintain upward momentum. In previous cycles, positive headlines alone were often enough to sustain rallies. Today, they are not. That tells you something important about the stage of the cycle we are in. When good news no longer moves the market upward, it usually means the market is searching for a new equilibrium. And this brings us to the point I want you to remember above all else. Markets do not move in straight lines, and they do not reward certainty. What they do is send signals, sometimes loud, sometimes subtle. Right now, the combination of a steep drawdown, fading volume, tightening global liquidity, and shifting investor psychology is forming a pattern that deserves attention. Not fear, not speculation, not impulsive conclusions, but attention. Because in financial history, the periods that feel the most confusing in the moment are often the ones that define the direction of the years that follow. Right now, I want you to shift your attention away from the price chart for a moment, because some of the most important signals in this market are not visible on the surface. They are coming from inside the network itself, from the machines that secure it, from the miners who are forced every day to make economic decisions under real pressure. And what we are seeing there is not routine. It is one of the sharpest drops in mining difficulty in years, a decline large enough to remind many analysts of the shock that followed China's mining ban back in 2021. When mining difficulty falls that quickly, it tells you something very specific. It tells you that weaker operators are shutting down. Electricity costs, financing costs, and hardware depreciation are forcing marginal miners out of the system. This is not speculation or sentiment. This is pure economics. Mining is an industry like any other, governed by input costs and output prices. When the price of Bitcoin falls, while energy prices and borrowing costs remain high, profit margins collapse. And when margins collapse, the weakest players disappear first. I want you to understand why this matters, because historically, miner capitulation has often been a turning point, but not always in the way people expect. During the 2014 cycle, during the late stages of 2018, and again in parts of 2022, periods of miner stress marked the final phase of market compression. Forced selling increased supply temporarily, pressure intensified, and then, slowly, the system stabilized as the least efficient producers were removed. This is a pattern that is repeated across commodity markets for centuries. In the oil market, in copper, in gold mining, when high-cost producers exit, the remaining structure becomes stronger, but the transition phase is always turbulent. There is another signal hidden inside this process that you should not overlook. Block times began to stretch, in some moments reaching levels not seen in normal operating conditions. That may sound technical, but it reflects a real slowdown in hash power, a measurable decline in the computational force securing the network. When that happens, the protocol adjusts, difficulty resets, and the system finds a new balance. But during that adjustment window, volatility often increases because the market senses that structural change is underway. Now, step back and think about the broader macro environment, because miners do not operate in isolation from global capital markets. Many of them financed expansion during the era of cheap money, when interest rates were near zero and liquidity was abundant. Equipment was purchased on credit, facilities were built with leveraged capital, and projections assumed continued price appreciation. But the world changed. Central banks tightened policy, real yields rose, and refinancing became expensive. That shift in the cost of capital is one of the most underestimated forces shaping the current cycle. You have seen this movie before, even if it was not in Bitcoin. In the late stages of previous tightening cycles, industries that depended heavily on leverage were always the first to feel stress. Real estate in the early 1990s, technology firms after the dot-com bubble, energy producers in 2015. Each time, the pattern was the same. When liquidity contracts, the weakest balance sheets fail first. What we are seeing among miners fits that historical pattern almost perfectly. But here is where the situation becomes more complex, and I want you to pay close attention to this contradiction. While some miners are shutting down, others are expanding, acquiring distressed assets, and preparing for the next phase of the cycle. This is classic market consolidation. Stronger players with access to capital often grow during downturns, not during booms. That means the current stress in the mining sector is not simply a sign of weakness. It is also a process of restructuring. And this is the point that many people misunderstand when they look only at price charts. The health of a network, like the health of any economic system, is determined by its ability to absorb shocks and reorganize. Short-term pain does not automatically mean long-term decline, but it does mean the system is under pressure, and pressure always precedes change. So when you hear about mining difficulty dropping, about miners capitulating, about adjustments in hash rate and block times, do not treat these as technical footnotes. These are the heartbeat of the network, the internal mechanics that reveal stress long before the broader public understands what is happening. And in every major financial cycle I have studied, the moments when the internal mechanics begin to shift are the moments when the future direction of the market is quietly being decided. Now, I want you to look beyond the charts and beyond the mining sector, because there is another force shaping this market right now, and it is slower, heavier, and far more powerful than most people realize. I am talking about policy, regulation, and the global macro environment, the currents that move entire financial systems, not just individual assets. And what we are seeing at this moment is a rare combination of uncertainty and transition that has historically produced some of the most violent market phases. You may have noticed that political rhetoric around digital assets has become more supportive in certain circles, and yet the market has not responded with sustained upward momentum. That contradiction is important. In past cycles, positive regulatory signals alone were often enough to ignite rallies because liquidity was abundant and investor confidence was fragile but optimistic. Today, the reaction is different. The market hears supportive language, but it hesitates. And when markets hesitate, in the face of good news, it usually means deeper forces are at work beneath the surface. One of those forces is the global liquidity cycle. For more than a decade after the financial crisis of 2008, the world lived in an environment of extraordinarily low interest rates. Capital was cheap, credit expanded rapidly, and risk assets, from technology stocks to cryptocurrencies, benefited from an almost constant tailwind. But tightening cycles change behavior. When central banks maintain higher rates for longer, capital allocation becomes more selective. Investors demand stronger returns for taking risk, and speculative assets face greater pressure. This is not theory. It is a pattern repeated across decades, from the tightening cycles of the early 1980s to the rate hikes of the late 1990s. At the same time, regulatory frameworks are evolving, and that process always introduces friction. Markets dislike uncertainty more than they dislike bad news, because uncertainty makes valuation difficult. When new rules for stablecoins, custody, or institutional participation are discussed or implemented, large players often pause. They wait for clarity. That pause can feel like weakness in the market, but in reality it is a period of recalibration. The same thing happened in the early days of derivatives regulation, in the emergence of electronic trading, and in the development of the ETF market. Structural change rarely produces immediate stability. I also want you to consider the role of expectations, because markets do not move on reality alone. They move on the gap between expectation and reality. After a major election cycle, after major policy announcements, after bold promises about innovation and growth, expectations can become extremely high. But when implementation takes time, when policies move slowly through institutions, the market begins to lose patience. That loss of patience is often misinterpreted as weakness in the underlying asset, when in fact it is simply the fading of unrealistic timelines. And here is another factor that many overlook: the dollar and global capital flows. Bitcoin, despite being described as independent, still reacts to the strength or weakness of the global reserve currency and to changes in international liquidity. When the dollar strengthens, or when global funding conditions tighten, capital tends to retreat towards safety. This has been visible not only in cryptocurrencies, but also in emerging markets, commodities, and even certain segments of the equity market. These correlations do not appear every day, but during periods of stress they become very clear. But what makes this moment truly complex is that the long-term structural narrative for digital assets has not disappeared. Infrastructure continues to develop, institutional custody continues to improve, and the technology itself continues to evolve. So you have two forces moving in opposite directions: short-term macro pressure and long-term structural growth. This tension creates volatility because the market is constantly trying to decide which force will dominate. I want you to remember something that history teaches us again and again. In the late 1970s, in the early 2000s, and in multiple commodity cycles, markets often entered long periods where the direction was unclear, where rallies failed and declines reversed, where participants felt exhausted and uncertain. Those were not periods of insignificance. They were periods of transition. And transitions are always uncomfortable because they force the market to redefine value under new conditions. So when you see hesitation in price, when you see mixed signals from policy, when you hear conflicting narratives about regulation and adoption, do not assume that the market is directionless. What you are witnessing may be something far more important: the slow and often invisible process by which a new equilibrium is being formed. And in every major financial era, the investors and observers who understood those transitions early were the ones who truly understood what was happening, even while the headlines were still arguing about what it all meant. I want you to focus very carefully now, because what we are approaching is the phase that confuses the majority of market participants. After sharp corrections, after minor stress, after policy uncertainty, there comes a period where the charts begin to compress, where volatility seems to shrink for a moment, and where many people believe the danger has passed. But in financial history, these quiet periods have often been the calm that forms just before a decisive move. Not always upward, not always downward, but almost always powerful. If you study past cycles, whether in Bitcoin or in other markets, you will notice a recurring pattern. After large drawdowns, markets often enter what technicians call accumulation or redistribution phases. Price moves in narrower ranges, momentum indicators flatten, and volume declines compared to the peaks of panic or euphoria. To many observers, nothing appears to be happening, but under the surface, positions are shifting, liquidity is relocating, and larger players are adjusting exposure. These phases are rarely dramatic in real time, yet they often precede explosive moves because the market builds energy while attention fades. I want you to think back to previous moments in financial history. Before the sharp rally in gold after 2008, there was a long period of sideways movement when sentiment was uncertain and conviction was weak. Before the major moves in technology stocks after the 2002 lows, there were months where volatility declined and headlines turned quiet. Even in Bitcoin's own history, major rallies have often begun not in moments of excitement, but in moments of boredom, when participation was low and expectations were modest. Markets tend to move most violently when the fewest people are paying attention. Now, look at the signals forming today. A deep correction has already taken place. Mining difficulty has adjusted, removing some structural pressure. Liquidity conditions, while still restrictive compared to past years, are being watched closely by global investors who are constantly trying to anticipate the next shift in monetary policy. At the same time, institutional infrastructure and adoption narratives continue to develop in the background. These are not isolated factors. Together they form a set of conditions that historically has preceded major directional moves. But here is the part that requires discipline to understand. Signals do not predict direction with certainty. They only tell you that the probability of large movement is increasing. In 2018, in 2020, and in multiple commodity cycles, similar compression phases ended in moves that surprised the majority of observers. Some expected immediate rallies that never came. Others expected endless decline that suddenly reversed. The market rarely rewards consensus expectations, especially when those expectations become too comfortable. And there is another element you must not ignore, and that is psychology at scale. After a painful correction, many participants withdraw emotionally. They stop watching closely. They assume that nothing significant will happen for a long time. That collective disengagement reduces liquidity, and when liquidity is thin, even moderate flows can produce large price movements. This is not speculation. It is a structural feature of markets that has existed for centuries, from the grain markets of the 19th century to modern electronic exchanges. So when people speak about an explosion signal, what they are really describing is not a prediction, but a condition, a combination of volatility compression, structural adjustment, and shifting macro expectations that creates the potential for rapid change. It is like pressure building beneath the surface of the ocean before a storm. You may not see the storm yet, but the water begins to move differently, the currents shift, and those who have watched markets long enough recognize the feeling even before the charts confirm it. And this is the final point I want to leave with you. Markets are not machines that move on schedules. They are living systems driven by human behavior, capital flows, and macroeconomic forces that interact in complex ways. The current phase may feel uncertain, even contradictory, but uncertainty is often the environment in which the most important transitions occur. What matters is not trying to predict every move, but understanding the forces that are building beneath the surface. Because once the move begins, once volatility expands again and momentum returns, it rarely gives much warning to those who are not already paying attention.